welcome to the Gift Show. My guest today is Liam Carroll. Liam, you're very welcome on the Gift Show.
Thanks very much, John, and thanks for having me.
I saw on the Andrew Neil show that the UK government have decided to leave their tax thresholds as they currently stand. That means when people get pay increases, more and more people will move from the 25p tax brand into the 40p tax brand. That means people are going to see an increase in their income tax payments to central government the next couple of years. It's one way of the UK government trying to get their accounts back in control. Aside from that, Liam, what can the person who's in a company pension scheme or who has their own personal pension scheme and they're in a defined contribution scheme, how can they protect their pension against inflation in the medium term? And also, how can they deal with the bearish stock market we have at the moment?
Thanks, John. There's a lot in that question, and we'll just go through it in a couple of ways. I suppose the historical belief is that there's two main ways of trying to protect your pension against inflation. And the first one is that you can index link your pension, which basically means that you can increase it by a set amount every year. So, for example, you might decide that if you are paying €100 a month every month, in 2024, you could decide to increase that to 105. In 2025, you can decide to increase that to 110, and so on and so forth.
Very good.
Basically, you're incrementally increasing the amount you're putting in, which negates that you have to remember to increase your lump sums on an annual basis. So that's one way that one can look at offsetting the effect of inflation. The second way then is that you can try and take a greater element of risk with your monies by investing them into the markets and hope to make a return in the markets which will be above the level of inflation. So, for example, we always say to people that there's 7 different categories of risk taker and based on an ESMA rating scale, which is a standardized investment scale within the industry.
Very good.
And number 1 being cash, and number 7 being exceptionally volatile stocks and shares. So, and obviously you have 2, 3, 4, 5, and 6 in between, John.
Very good.
So, as someone is getting closer to retirement, the lower down the scale they get in relation to how they invest their monies. So obviously inflation will have an element of risk there because you're obviously not going to make the same level of return if the markets are good. So what we're saying to people is that in the long term, that if people want to try and beat inflation by using the markets, they have to take an extra element of risk to try and get returns that are going to be above the inflation level. So, for example, if somebody in the long term was inside a number 5 or number 6 rated fund, history has shown that they would make a greater level of return than somebody who's inside a number 1, 2, or 3. But the difficulty is, of course, that if people need to access the money fairly quickly, be it in a savings pot or a pension pot, they can't afford to take that element of risk. So they are going to get caught with the inflation risk, which is just an unfortunate way of it. So I suppose the two reasons, John, the two methods of trying to beat inflation are, to summarize, by indexation, which is increasing your monies on a regular basis every year, or also by trying to beat it by investing in greater risk-rated funds within the markets.
I understand what you're saying there, Liam. So I think what you're saying there is, if, for example, you decide to increase your annual pension payment by 5% per year, that's fine when you have low inflation, maybe 1 or 2%. You're effectively getting a real increase in payment of 3%.
Correct.
On the other hand, that if we have, as we do at the moment, we have inflation that's close to 10%, and you increase your annual payment by 5%, effectively your payment is going down in real terms by 5%. So you might need to look at maybe increasing your payment by 15% to keep up an increase in real terms in your pension payment. So that's a personal issue for a lot of people.
It's a difficult one, John. And then, as you say there with that, like that you're down 5% in that example that you use. Like, so what you're hoping is like that inflation rates won't stay at that level long. Now, who knows, John? But we're
Yeah,
hoping they won't stay at that level long term. So if you have maybe the standard 5% increase,
yeah,
you'll be hoping that on an average basis that would close to cover off the inflation risk anyway.
yeah.
It's very hard to get it exactly spot on, but I mean, at least you're doing something about it anyway, John, isn't it?
And the other thing you mentioned there, of course, is the volatility of your investment.
Yeah,
So you could decide to put more money into cash funds. It's a low risk investment, but the returns are minimalist. On the other hand, if you decide to invest into Far Eastern stocks or into technology stocks, where there's a greater element of risk,
yeah,
you make more return, but it's about getting the timing right. And nobody can determine what way the stock markets are going to be as you approach your retirement. So there's always an element of risk in doing what you're talking about there and putting more money into the Far Eastern stocks or into technology stocks. And we've seen over the past couple of weeks that technology stocks have taken a battering on the stock markets, with billions upon billions being written off the value of companies such as Facebook, Meta, Twitter, to name but a few.
great,
In
John.
terms of, managing let's say you have a fund of a couple of 100,000, how do you then decide to diversify some of that risk, into cash funds now as you approach your late 50s, early 60s? How does a person decide to manage that stock market volatility as they approach retirement?
It's an interesting one, John, and there's four different categories of fund choice, if we might call it like that, in that you have bonds, property, equities, and cash. Four different asset classes is the word I was looking for. It wouldn't come
Yeah.
to me, John. So you have the four different asset classes. So the long term or the historical view would have been that as you get closer to retirement, and we're talking about a pension context here, that you would have a greater element of your fund inside in cash, maybe in bonds. And as you're maybe a 30-year-old / 40-year-old, you could have a greater percentage inside in equities to try and make a return on the markets. But interest rates have increased slightly, so that has made the cash slightly better value, but still it's not somewhere somebody should be in long term. It's okay maybe for a very short term period if somebody is afraid of the volatility in the markets. But the bond market is the one that has been very poor over the last year or two, which had normally been a bit of a safe haven, but it has been poor. A lot to do with the interest rate and inflation as well. Like that has been a safe haven for people, and it hasn't proven to be as much of a safe haven as people thought. So it's actually quite an interesting one that certain elements of the equity market then have performed well. Obviously, the energy element of it, and as you very eloquently and correctly pointed out, the technology funds have performed very poorly overall. So the big thing I always think is that it's a communication piece, John. That if you have your pension pot with a financial advisor and you're looking to retire in a couple of years' time, it's very important to meet them on a regular basis to go through the funds, how they're performing. Do you need to decrease your risk inside in certain elements of it just for peace of mind and to make sure that you don't have significant losses when you're close to the end game. So communication is a massive part of it, John. When we're going through them, we have a house view for people set up, which has a mix between equities, bonds, cash, and property. And the closer you get to retirement, the greater the exposure towards the cash element of it would be. But it's all about communication with people, John. It's very important to communicate with your advisor. They're getting paid for it. We're getting paid for it. So make no apology about trying to meet up with them. And now, John, as you have found out the onset of these technological items like Zoom and everything, there's no excuse for not being able to do a quick 10-minute Zoom call with someone just to see how your pot is performing, and just do that on a regular basis. That's the big thing, John.
Of course, yeah. That's very good advice there. I think it's what you're saying there effectively, Liam, is to keep the communication channels open between yourself and your pension advisor, and they'll be able to give you pertinent advice on what's best to do in your own particular circumstances. There's no one size fits all. You have to allow for the fact that everybody has a different attitude to risk. Some people might say to themselves, well, hopefully this is only going to be a short-term problem, and I can ride it out and I can continue as I'm doing. Other people might decide to put more of their pension pot into cash funds because they're becoming more concerned about the value of their pension fund, and they don't want to see it being reduced because of market volatility, and they decide to go for the safe haven. So I think that's good advice there. Yeah. Is there anything else you'd like to say to the audience before I let you go, Liam?
It's like I said to the audience, John, you're out to catch me on the hop now, John. Not really. I think to summarize what you said there, the communication is the big thing. So if you have pension pots that you haven't looked at in a long time, make sure to dig them out and have a look at them, because what might have been suitable for you 15 years ago mightn't be suitable now, and you might have done very well in the markets, and you could end up being more at risk now. So it's just very important just to have a look at your policies, try and get them in order so that you know where they are, and make sure just to be in communication with your advisor on a regular basis. And I think that's the communication piece has got more and more pertinent and important, because, for example, John, the markets in 2021 would have been, people did very, very well. They would have, in the vast majority of cases, and I'm generalizing here, had lost the gains that they made in 2021 in 2022. So it's important that people get a stance on where they're at and just are in communication, and that if 2023 is going to be the same as 2022, to make sure they're inside in funds that suit their attitudes to risk and their needs at this stage, and how long they have left before they need to access the pot. So it's just communication, John, is the big thing, and make sure that they link in with their advisor on a regular basis.
This has been a very interesting conversation today, Liam, and I think what you're saying there is people need to take stock of where they are with their pension.
Yeah.
Look at their age group. Look at their attitude to risk.
Yeah.
Are you a person who's going to take a greater attitude to risk in these bearish markets, or are you going to move your funds towards cash funds?
Yeah.
And also, finally, then to keep the communication channel open with your pension advisor. Ask them for relevant advice. They're there to help you. That's all good advice for the public that are involved here today in trying to build a pension scheme for themselves. And on that note, I'll bring today's conversation to a close. Thank you, Liam.
Thanks, John. Enjoyed that. Thank you very much.
You're very welcome.